Okay, so today, the U.S. Federal Reserve is stuck. And I mean really stuck between a rock and a hard place. And their decision, well, it's a story all about war, oil prices shooting through the roof, and a huge choice that could either let inflation run wild or push us all into a pretty painful recession.
You know, if you just glance at the markets, everything seems fine. Kind of calm, actually. We just had 2 straight days of gains, which is the first time that's happened since the U.S. strikes against Iran started. You look at the Dow, the S&P, the Nasdaq, they're all ticking up. It really feels like, okay, maybe the worst is behind us.
But yeah, that calm, it's really, really deceptive. Because while the stock market seems to be breathing a sigh of relief, there's this huge shockwave rumbling just under the surface, and it's coming straight out of the Middle East.
And boom, here it is, over $103 for a single barrel of Brent crude. I mean, we haven't seen prices like that since back in August of 2022. And let's be clear, this isn't just some abstract number on a screen. This is a real shockwave, and it's aimed right at the global economy.
So you see the puzzle, right? It's just weird. Stocks are holding steady, but oil, this incredibly crucial commodity, is basically screaming red alert. And this strange disconnect, it's exactly why everyone, from policymakers to investors, is glued to the Federal Reserve today. It feels like we're all just holding our breath, waiting for that other shoe to drop.
Okay, so to really get why the Fed is in such a pressure cooker, we need to talk about something market strategists are throwing around a lot right now, a black swan event. Because that conflict you see on the news, the one that feels so far away, well, its impact is hitting very, very close to home. So what the heck is a black swan? Simple. It's something that comes out of nowhere, is totally unpredictable, and has massive, massive consequences. And according to analysts, what's happening in the oil market right now? It's a textbook example.
Now, this chart really shows you what they mean. It uses something called a Z-score, which is just a fancy way of saying how weird is this price move compared to normal. And just look at that. The move in crude oil is off the charts. It's what they call a 7 standard deviation event. That is a huge outlier. But then look at stocks and bonds. They're just kind of puttering along with what analysts are calling normal white swan moves. They haven't caught on to the danger, at least not yet.
And here's where that black swan stops being a market term and starts hitting you right in the wallet. $3.80. That's the national average for a gallon of gas now. That is the direct line from a conflict thousands of miles away right to your family's budget.
So you can see how all of this puts the Fed in what feels like an impossible spot. It's like they're walking a tightrope. Fall one way and you've got runaway inflation thanks to this oil shock. Fall the other way and you tip the whole economy into a recession. It's not a great choice to have to make.
So let's break down the 2 nightmares they're staring at. Option 1, fight inflation. I mean, oil prices have jumped by 1/3 since the war started, and other costs are still way too high. But option 2 is to avoid a recession. The job market's hit a wall. Unemployment's starting to tick up. The data is looking, well, wobbly was a good word for it. So what do? Do you hike rates to fight inflation and risk killing the economy? Or do you cut rates to save jobs and risk letting inflation completely off the leash?
And this isn't just some academic debate for them. The whole situation is basically haunted by the ghost of a past economic crisis, one that absolutely terrified a whole generation of policymakers. To really get why the Fed is so nervous right now, we got to jump in the time machine and go back to the 1970s.
So back in the 70s, you had a really similar setup. Energy crisis was making inflation go completely haywire. And for years, the Fed kind of tiptoed around it, not doing enough. Then, in 1979, this new Fed chair, Paul Volcker, came in and basically said enough is enough. He did the unthinkable. He jacked up interest rates like crazy to break inflation's back. And you know what? It worked. But the cure was almost as bad as the disease. It caused a brutal double-dip recession. Millions of people lost their jobs.
And that history lesson is seared, absolutely burned into the institutional memory of the Fed. Nobody, and I mean nobody, wants to be the Fed chair who has to pull a Volcker to let things get so bad that they have to purposely cause a recession just to clean up the mess. They are all thinking an ounce of prevention is worth a pound of cure.
Okay, so all that history is why the big headline you're going to see everywhere today, what the Fed did with interest rates, is actually the least interesting part of this whole thing. The real story, the real drama, is buried somewhere else. Look, the consensus is pretty clear. The Fed is going to keep rates exactly where they are. That's not the news. Where you need to look is a document they release called the Summary of Economic Projections. Think of it like the Fed's private report card for the whole U.S. economy. That's where the secrets are.
And this is what all the pros will be digging into. Simple questions, really. What's their new forecast for GDP? Are they expecting more job losses? And here's the big one. How do they see inflation? Do they think this oil spike is just a blip, something they can look through, or is it the real deal? And then there's the infamous dot plot, which is basically their secret map of where they think they'll cut rates in the future.
So, what should we expect from the man himself, Fed Chair Jerome Powell, when he gets up to the podium? Well, experts think the key word is going to be patience. He's probably going to come out and say they're in wait-and-see mode, trying to sound calm and collected. Basically, he's going to try to thread the needle, calm everyone down without locking himself into any future decisions.
But here's the thing. Trying to preach patience is a lot harder when you throw two more huge wrenches into the mix. First, the war isn't ending. And second, there's a giant question mark hanging over the Fed's own leadership.
And get this. This is actually supposed to be Jerome Powell's second-to-last meeting as chairman. His term ends in May. But his replacement, their confirmation is totally bogged down in the Senate. This creates a scenario where we could have a leadership vacuum at the Fed, literally in the middle of one of the most critical moments imaginable. You couldn't write a worse time for this to happen.
And that brings us full circle, right back to that weirdly calm stock market. Because the very same people who spotted that oil black swan are now waving a red flag saying, hey, this calm can't last. They're warning that if this conflict drags on and oil stays this high, that gap between oil and stocks is going to snap shut. And when it does, they're predicting a drop of anywhere from 5 to 20% in the stock market.
So in the end, it really all boils down to one big bet. The Fed wants to believe this oil shock is temporary. They want to look through it, cross their fingers, and just wait it out. But with the war raging and their own leadership up in the air, you have to ask, is that a bet the market, or any of us, can really afford to make?